£1,300,000,000. That was the hole left behind when Polly Peck International collapsed in September 1990, a company that had made its shareholders 200 times their money in a single decade. Gone in a month. To understand what happened, you have to go back to 1980. Polly Peck was a small, nearly worthless textile company listed on the London Stock Exchange. Its shares traded for pennies. Nobody was watching it. Nobody cared. Then a Turkish Cypriot businessman named Nadir bought control of it, and within a year, the share price had multiplied by a factor of 18. Investors who had written the company off as a relic were suddenly paying attention. Nadir had a story to tell. He was building a trading empire across Turkey and northern Cyprus. Fruit, electronics, hospitality. The brands were real. Del Monte's European and Middle Eastern operations. Sansui Electronics, a hotel group. The revenues looked enormous on paper. The annual reports were glossy and confident. City analysts upgraded the stock. Fund managers loaded up. By the late 1980, Polly Peck was a FTSE 100 company, one of the 100 largest businesses in the United Kingdom. Its market capitalization peaked at around £7 billion. If you had put £1,000 into Polly Peck shares in 1980, by 1988 you were sitting on more than £2 million. That isn't a rounding error. That is the kind of return that makes people religious about a stock. But there was a mechanism running underneath the surface that almost nobody saw. Northern Cyprus, the Turkish-occupied north of the island, unrecognized by every government on earth except Turkey, operated in a financial gray zone. Banking regulations there were thin. Oversight from London was essentially non-existent. Nadir had built a network of subsidiaries in that territory, and those subsidiaries were receiving money. Large amounts of money. The flow went like this. Polly Peck's UK operations would generate sterling, which would be converted into Turkish lira and sent to the subsidiaries. The lira was a weak currency. It depreciated constantly against sterling. So every time money made the round trip, value evaporated. But on the company's books, the subsidiaries reported assets in local currency that looked healthy at the moment of recording, before the exchange rate moved against them. The losses were real. The reporting was, to put it plainly, constructed to obscure them. Investigators would later allege that more than £700 million was siphoned out of the company through this network. Not borrowed, not invested, transferred to accounts and entities that Nadir allegedly controlled personally. The auditors signed off year after year. The board asked few hard questions. The city was making too much money on the share price to look too closely at the plumbing. In the summer of 1990, the Serious Fraud Office opened an investigation. That was all it took. On 20 September 1990, administrators were appointed. Trading in Polly Peck shares was suspended. The stock that had been worth 422 pence just weeks before was now worthless. Shareholders, pension funds, retail investors, ordinary people who had trusted the annual reports, lost everything. The company owed £3 billion it couldn't repay. Creditors would recover fractions of their claims, if anything at all. Nadir was arrested in December 1990. He was charged with multiple counts of theft, but the criminal case moved slowly, as serious fraud cases do. The evidence was complex, the legal arguments were dense, and Nadir had resources and a legal team. He was released on bail. And then, in May 1993, he made a decision that would define his story for the next 17 years. He boarded a private jet at Compton Abbas Airfield in Dorset and flew to northern Cyprus. He left behind a £5 million bail bond. He left behind the United Kingdom's jurisdiction. He left behind approximately 70,000 shareholders who had lost their savings. Northern Cyprus has no extradition treaty with the UK. Nadir knew this. He stayed there. He gave occasional interviews. He maintained his innocence. He lived comfortably. Meanwhile, the victims of the collapse lived with what they had lost. Pension funds that had held Polly Peck shares had holes in them. Individual investors who had concentrated their savings in the stock had nothing to show for it. The administrators spent years trying to recover assets, pursuing claims through multiple jurisdictions, recovering a fraction of what had vanished. For 17 years, the story seemed like it might end there. A man who had walked away from British justice, living untouchable in a territory that didn't formally exist on the international legal map. Then, in August 2010, Nadir announced he was returning to the United Kingdom voluntarily. He said he wanted to clear his name. He was 69 years old. The original charges were reinstated. The trial began. It lasted months. The prosecution laid out the movement of funds in meticulous detail. The defense argued that Nadir had been lending money to the subsidiaries, not stealing from shareholders, and that political interference had tainted the investigation from the beginning. The jury was unconvinced by the defense case. In August 2012, 22 years after the collapse, Nadir was convicted on 10 counts of theft, totaling £29 million. He was sentenced to 10 years in prison. He was 71 years old. He was released early on compassionate grounds in 2016 and returned to northern Cyprus. £29 million. That was what the conviction covered. The rest, the full £700 million, allegedly moved through the subsidiary network. The £3 billion of total debt remains in the category of documented but not fully adjudicated. The administrators recovered some assets over the years. Not enough. Never enough. There is a pattern that runs through every story this channel examines, and Polly Peck is one of its clearest examples. The warning signs were visible. Short sellers had been publishing research questioning Polly Peck's cash flows years before the collapse. In 1989, a firm called Elliott Bernard circulated a note raising questions about the currency risk embedded in the subsidiary structure. The response from the market wasn't investigation. It was fury. Fund managers who held the stock attacked the short sellers publicly. Nadir himself called the skeptics enemies of the company. The share price kept rising. The warnings were not secret. They were ignored because the story was too good and the returns were too large for anyone with a financial interest in the stock to want the story to end. This is how money dies at scale. It doesn't die because the fraud is invisible. It dies because the fraud is profitable for enough people that nobody with the power to stop it wants to ask the question out loud. The auditors sign. The analysts upgrade. The fund managers buy more. And the ordinary investor, sitting at the end of that chain, holds the shares that are worth 200 times what they were a decade ago, and feels safe. Because 200 times safe is the safest feeling in the world. Until September 20th, 1990, when the administrators walk in, and the number on your statement goes to 0, and the man who built the whole thing is on a plane to an island that doesn't officially exist. £1.3 billion. Documented. Owed. Gone.